One of the things that real estate agents spend, I would say, a majority of their time on is figuring out how to make more money. Whether that's get new leads, whether that's raise their price point, whether that's get closings at all. A lot of times it's always, I would say probably most of their mindset when it comes to money is how to make more. We've talked in different podcasts before about how to make more money. You can do more deals or increase your commission percentage or get higher price listings. So there's lots of ways to get more money.
Yeah.
What I think a lot of people don't spend much, if any, time on is how to spend less money. And when I say spend less money, first thing people, I think, if you're listening, you're probably going to think, okay, what subscriptions can I get rid of? How can I utilize AI or something so I can scale without adding more employees? But what you have been talking about recently and has been super positive response from our team is not about cutting expenses or cutting anything from your business. It's still doing all that you are with your business, but it's how do you spend less money? For me, it's April 15th. For some people, it's September or something. I don't know.
September for S Corp, yes.
I'm pretty proud of that. And how do you spend less money when it comes to taxes?
Yeah.
That was a really long intro, but I thought it was really good.
Feel good about it? I feel good about it if you feel good about it, Brian. Cool.
You feel bad about it, but I feel good about it, so let's go.
Yeah, we'll dive in. This is a passion project of mine. It always has been from the first time I ever stroked a 6-figure check to the IRS, and I sent it to them, and then they didn't send me anything in return.
Not even a thank you letter.
It was quite painful to go through that experience. And from that moment on, I've really, really obsessed over trying to mitigate taxes as much as humanly possible. Disclaimer, I am not a CPA or financial advisor, accountant, attorney, any of that stuff. You should talk to experts for tax and legal advice. Don't consider anything I say tax or legal advice. These are just some things that I have understandings on and have acquired over the years. But if you do any of these and they don't work out for you, it's not my fault. That's what I'm saying.
I'm really worried when we cut clips that I'm going to have to put this whole 45-second disclaimer in it, and you're going to say 10 seconds of clip.
Yeah, it's cool. But anyways, guys, welcome to the Whissel Way podcast. My name is Kyle Whissel, your host with eXp Realty in San Diego.
And I am Bryan Koci.
The goal of the show is to give you the tools, techniques, and tactics to go out there and crush it in your business. The way that we like to do that is to answer the questions that you have for us. So if you ever have a question you want to have it answered here on the show, you can always go to thewhisselway.com. You can ask us questions on there, subscribe to the podcast and YouTube channel, join our private Facebook group, get on our email newsletter where we share a lot of tips and tricks. And if you want to level up your content creation game, we offer a course called the Media Mayor Mastermind. We'll teach you everything Brian and I have learned over the last 10 plus years of creating content together. Audio content, video content, social content, just all the contents. We'll teach you everything. All of that stuff at thewhisselway.com. Well, let's jump in, Brian. Where do you want to begin?
Well, we kind of teased it a little bit with April versus September.
Yes.
But let's dive in with an S Corp. Why is that important? How much does it cost and how much does it save?
Yeah, absolutely. So the foundation that every real estate agent should have that has a goal to make more than $50,000 this year, which should be all of you. If you are watching this show or listening to this show, I am assuming you have aspirations of making north of $50,000.
I can't imagine you'd listen to this if you don't.
I would hope so, right? We have aspirations on Whissel Beer Group that over 100 agents inside of Whissel Beer Group will make north of $250,000. To us, 250 is the new 100. 100 used to be like the benchmark number that everybody always wanted to hit for a long time. We're moving that benchmark up. We're raising the bar. We're moving the field goal post, whatever term you like. We're moving that. It's 250. That's where we want to get all of our agents to now. And so being that 50 is where this really starts to take effect, this is something that every real estate agent should have. And whether you know this or not, you actually have a business. Some of you guys are like, well, I don't have a business as an agent. Like I don't have a LLC or a corporation or any of that stuff. So I don't actually have a business. You do. Regardless if you have an S Corp or an LLC, if you don't have either of those, you have what's called a sole proprietorship. And the thing here is that when you fill out your tax return, You're going to take your business income, take off your business deductions from that, and you're going to be left with a number. That's going to be the number that you are going to pay taxes on for your business. And again, your sole proprietorship is a business. You are going to pay 15.3% tax, which is also known as a self-employment tax. Now, here's the key. If you have a sole proprietorship, let's assume that number that's left over after you take your top line and then subtract all of your deductions, let's assume that's $250,000, because that's the goal. That's the goal I want all of you that are tuning into the show to get to as well. If you're a sole proprietor, you are going to pay that 15.3% on the entire $250,000. If you have an S corporation, alternatively, you could have an LLC and you can make an S election on it. Then it's taxed as an S corporation. So it functions the exact same way. So an S corporation or an LLC with an S election, either one works.
I like how you put that in for the haters, because someone's going to go, in the comments, you could do this. And you're like,
I've had so many times that I've just learned, yes, you can do this with an LLC. But the only reason you would have an LLC with an S election would be because you've set up a normal LLC because somebody told you to, and then you realize you screwed it up, and then you had to add the S election to it. You should have just done an S corporation in the first place, and you would have made your life easy. But you got bad advice from somebody. So it should be an S corporation. If somebody told you wrong that you should do an LLC, you need to make sure you add the S election to it so it becomes an S corporation. So here's the big difference. When you do an S corporation, instead of taking that $250 and paying 15.3% on the entire thing, you get to break that $250 into two buckets. Bucket one is your salary. Bucket two is distributions. What is salary? Salary's got to be a reasonable number based on what the income of the business is. At a $250,000 business, you could probably get away with, I'm not the expert here, talk to your CPA, whatever number they tell you is what you should do, but probably somewhere around 75K, maybe 100K. There's a guy that I follow. His name is Mark, and with a K, Mark J. Kohler, Kohler. I follow him on YouTube primarily, but he's on all the socials. And he has something called the Kohler Payroll Matrix, where he can give you, hey, if your income is here, this is what we recommend you claim for the recommended salary that you should take at this income level. And then there's an entire chart. And he says this in his own words. He's never had a client audited because of the salary they've taken on their S corporation. So take that for what it's worth. That's his saying, not mine. But I believe that $75,000 on a $250,000 business is probably a reasonable salary. But you claim whatever you want. Make sure CPA is on board with it, because they're the ones got to fill out the returns. So
wait, real quick. I just Googled an image of it.
Yes.
And it looks like between 200,000 they say is 70, and 300,000 is 90. Is from this image that I'm seeing. So
yeah, so 75, it's in that range, 75, 80, whatever. We'll just go 75 for argument's sake here. So here's what's cool is whatever you take for salary, you're going to pay that same 15.3% on. But the remainder is going to be considered a distribution. And now people get this all screwed up in their heads. They think a distribution is a complicated process. That could simply be an ATM withdrawal. That could be transferring the money from your business account to your personal account. Very simple. Distribution is just how did you get the money out of the business account, period. Anything that wasn't payroll is going to be considered distributions. So you could take $75,000 as salary, $175,000 as distributions, two buckets. But you're only going to pay that 15.3% business tax on the salary. So in this scenario, $250,000 sole proprietor, you're going to pay 15.3% on the whole thing. It's about $38,000. Alternatively, if you go S Corp and you do a $75,000 salary, you pay that same 15.3%. It's like $11,000. You're talking close to a $27,000 delta in the amount of tax you're going to pay at the business level just by having an S corporation.
Okay. I'm going to play devil's
It's a
advocate.
big number. And now I just want to clarify, this is at the business level. This does not affect your personal return. This is your business return.
So when you do an S Corp, you
Yes.
have to pay to get an S Corp established.
Yes. Depending on your state, here in California, our attorney charges around $1,000 to set it up.
Okay.
One time.
And
you're going to have an annual fee. California has an annual fee that's the highest in the country, I believe, at $800 a year. Other states, there's no fee or there's a nominal fee.
So the first year you set it up, it's $1,800 in California.
Yes.
And then it's $800 after that.
Yes.
Okay, so we get what was the delta? The $27,000.
$27,000 roughly.
Sure. So now let's bring that down to $25,000.
Yes.
Okay, but you also have to do payroll.
You have to hire a payroll company. I don't even know. We use something called Gusto. And I have a link. Just DM me. I'll send you where you'll save. I think it saves like $100 or $200 when you run your first payroll. So just DM me. I'll send you a link that'll save you some money. But Gusto, you set up. I don't know what it costs. Like nothing.
Probably $25,000.
Yeah, I'm sure that's what it costs. And everybody gets intimidated about setting up payroll for their salary. Like, guys, it's very, very simple. It will take you like 5 minutes to set it up. It's not hard. Gusto makes it very, very easy. So you're going to set up the salary. So there's some cost for Gusto. I don't know what it costs. Let's say it's $50 a month. I don't know what it actually is. So I don't know. There's another $600. So you're at $2,400. And you need to set up a business bank account, which there's probably no cost for that. Maybe you have a nominal cost. So we'll call $2,500. And then you got to file a business tax return because you actually have a business. But you're already paying extra money because you're filing a sole proprietor return, which I think is a Schedule C, if I remember correctly. So you already were paying. So I don't know that you could say that there's a significantly higher cost for tax prep. So $2,500 in the first year, and then you're at $1,500 a year to maintain it. So $27,000 savings for $1,500 to $2,500 a year to have it. Like, it's a no-brainer.
Is that why you said it makes sense if you're making over $50K?
Yeah,
because of the cost associated.
Yes. Yep.
Okay.
That's where anything you do, there's always a cost-benefit analysis. So Mark J. Kohler, who's one of the guys I follow, the other one I follow is Carlton Dennis, Carlton with a K, Carlton Dennis. Both those guys are the same thing. If you're making over $50,000, you should have an S corporation.
And is this true
for you stubborn people in an LLC with an S election?
Is this true for anyone with the business, or is it just specifically real estate agents?
Any sort of small business, you should do this, yeah, but specifically real estate. But yeah, this applies across the board.
Okay, so right now, the time of filming, it's December 18th.
Yes, sir.
So it's the end of the year.
1 week till Christmas.
Oh my God. No, thank you. Man, you threw me off there. Okay, so it's December 18th, 1 week till Christmas. People are getting ready for taxes. People are looking to buy cars.
Well, let's hit on this too real quick. This, you cannot, there's some things you can do where you can have these like Hail Marys you can do at the end of the year and may have a big impact. This is not one you can do at the end of the year for the year that was. All you can do is set yourself up for the year that's to come. So setting up your S corporation today is not going to help you for 2025. It's just going to set you up for 2026. Now, here's your one caveat. If somebody told you should have an LLC and you've been running under a traditional LLC all year, today you could flip that and add an S election, and that would take effect for all of 2025. So if you have a regular LLC without an S election, you could throw a Hail Mary right now and flip that to add the S election and cover yourself for all the money, because it's the same entity. All the money came into that entity. So therefore, you're just changing the way your entity is taxed. You're not actually changing the entity itself. So if you have had an LLC all year without the S election, you could add that S election now, and that would actually benefit you for 2025.
Okay, a couple more things. One, I'm guessing it's prorated. Someone's listening to this in March, and they go, "Okay, cool. I'm going to do an S corp right now. I have a sole proprietorship." You don't have to set up in March and wait for the following calendar year.
Right. It's just from the time you set it up. But if you set it up in March, the money that came in prior to that is going to be taxed as a sole proprietor only once you've set the entity up and start receiving money in that entity. So one thing that's important is you need to make sure your broker knows that you have said entity, so the checks are going to said entity. That's a very important part of this.
Yes. So reach out to how you're getting paid and make sure they're paying into that business bank account, I would assume?
Yes. Okay. So like EXP, go to myexp.com, just change how I get paid. It's very easy. Some of your brokerages, you guys might have to like fax your broker or something because you guys are old school brokerages.
Mail it in with
like carrier
30
pigeon.
stamps.
Yeah.
Dude, I never know how many stamps to put on. I put 40 stamps on a letter. I'll make sure it's good to go.
Nice.
Carry on.
Okay. So next one on my list is hiring your family members. So this is something where you could have family members that could work for you. So you could have, now this, depending on the age, things change around a little bit, but especially if you have kids that are under 18. The beauty with that is that if you have kids under 18, you can 1099 them. You don't have to worry about paying payroll tax. You don't have FUTA, federal unemployment tax. Like, you love that word, huh? Not FUPA, FUTA.
Carry on.
FUTA. And so then you could pay your kids, and you could go like you could pay them whatever you want, but the standard deduction in 2025 is $15,750. So you could pay your kid $15,750, have no payroll tax, no unemployment tax, just so I don't make you giggle again. And so now your business is taking a $15,750 write-off. Then you're paying your kid. Your kid is taking that money tax-free because as long as the income was up to the standard deduction or less, they're going to wipe all that out. There's no tax liability on that. So it's a way for you to reduce your tax liability as a business and then give your kids money tax-free. Now, you should be able to substantiate, right? If you got audited, could you prove your kid does something? One of the easy things, my kids are my mail clerks. So they get the mail every day. They sort the mail. They shred the mail. Not my 3-year-old, my 9-year-old shreds.
She shreds it a different way.
But that's part of my kids' job is that they are my mail clerks, right? And so they sift and sort mail, and they categorize it out. They shred. They do all of that stuff. So like that's an example of something your kids could do. Maybe your kids stuff envelopes for you, stamp envelopes, so that Brian doesn't have to get confused.
They can't do too many stamps.
Yeah, right. What could your kids do? So ideally, if you got audited, you could support the payment that you made to your children was for something reasonable. The other beauty, if you have family on payroll because they work for you, you could also have family board meetings where maybe you do a board meeting in Hawaii every year. And so now you can start to get very creative and have a family or a business board meeting that your family members come to in Hawaii every year. And you can start writing off a lot, not all, but a lot of that board meeting that you guys had. So having family members on there, especially ones that are under 18, that gets really attractive. And then you can also layer on top of that and have that money go into a retirement account for the kids. So you could have that money go into an IRA for your children. Then now that money could go in and they could have self-directed, invest it so it could grow as well. So you could start setting your kids up for retirement. Or you could give your kids a debit card, and the next time your kids say they want an ice cream, like you pay for it, right? Because they got money in their bank account.
I would say that's where, because that all sounds great when you're like, hey, I'm floating in money, right? Yeah. But if you're like, if you're starting out and we're not at the 250 point yet, and we're not, right? I'm not there. What you said in the past, and maybe you said it at the meeting, what I love about it is, hey, when you're going, you can pay for your kids' the kids can pay for their own gymnastics. Their ticket to Disneyland.
All those things that are not a write-off, there's no way you could write them off from a business perspective. Your kids can now pay for that stuff.
Yeah. And so
your kid wants that $50 stupid stuffed animal at Disneyland, like, cool, they can use their card and pay for it.
Bikes, like all the stuff that you... It would probably be hard for Christmas presents, right?
Yeah, now you're reaching.
You buy your own Christmas presents. That's a little mean.
Cool.
Okay, hire family members next.
Yeah, next one. So this is something I found. If you're listening or you're tuned in, I am going to venture to guess that at least 75% of you, real estate was not your first job. You had some other job before you got into real estate. And a good percentage of you have a IRA or a 401k or some sort of retirement account that you had set up at your previous employer, and it's still just sitting there. And most IRA accounts, 401k accounts in our country are earning between 5 and 10%. I think it's 7 or 8 is like the average. So you have this money that's sitting in an account earning less than 10% on an annual basis. Did you know that you could take that money that's in that old retirement account, roll that into what's called a self-directed IRA, And then you can direct where those funds go. I don't know, do anybody tuning in know anything about this little thing called real estate?
I know someone.
Yeah, okay. Well, wouldn't it be cool if instead of having your money into these like mutual funds and bonds and stocks that you probably don't have any clue what the hell you're investing in, you're just taking somebody's advice, or you're throwing a dart at a board and just picking something random hoping it goes up? What if instead of doing that on a regular basis to get 5 to 10%, what if you actually took that and you could go flip properties with that? Or what if you bought a buy and hold property? Or what if you built an apartment building? What if you invested into a syndication, right? Or invested into a fund, something like that? Like, what if you actually invested that money into something that's going to grow for you, as opposed to just letting it earn 5 or 10% a year? You think you could do better than 5 to 10% if you were, even if you just flipped like a property a year? Think you could do better than 5 or 10%? I would be willing to bet on most of you. Are you willing to bet on yourself?
Yeah, if you're going to flip a property, no one's going to do the numbers. Now, things happen, right? But no one's going to do the numbers and go, okay, I'm going to flip this property. I'm going to spend 6 weeks. I'm going to hire these people. I'm going to deal with all the things. And I hope to get 5 to 10%.
That's insane, right?
Like as an investor, you're typically looking for what, a 30%?
A lot more
20%?
than 5. That's for damn sure. Yeah.
Yeah. And now, again, things happen. But still, things happen in the stock market.
Yeah. Are you going to do a flip that's going to take you an entire year? You're going to put $200,000 into it with a goal of making $215,000, like getting $15,000 out of it after an entire year, because that's what your old IRA is probably doing right now. That's crazy. You could do so much more with that. So that's something I think everybody should be looking at, is first taking that money, getting it into a self-directed IRA. Alternatively, you should have some sort of a retirement account that you have set up. So you could do like a traditional IRA. The limit this year, I believe, is $7,000. So you could have $7,000 pre-tax dollars or post-tax, your choice. $7,000 go into an IRA account, and then you could self-direct that. So you could go invest that into real estate. Or there's something that's called a SEP IRA, which that actually allows you to put up to $70,000 a year. So you could actually have $70,000 pre-tax dollars go into an IRA every year, so you could reduce your tax basis, and then that $70,000 you could put into a self-directed IRA, and then you could go buy real estate with it. Which is pretty crazy, right? So $70,000 pre-tax dollars, and then go invest it and have that thing grow and grow and grow and grow. But a lot of us are not taking advantage of that, or we're putting it into like a 401k, and then again, it's going into mutual funds and bonds and stocks that we don't understand.
Okay, so you kind of glossed over this really quick. We talked a little bit more about flips and that process. When someone's listening to this and they go, cool, Kyle, I get it. I run into flips, but I work full time. I coach 3 basketball teams. I do this. I don't want to deal with the headaches, the all the work. I don't want another job. Even if it's another $40,000 I can make in 3 months, I don't have the time. You mentioned really shortly, you said, flips or funds.
Yes.
Tell me what the fund, I know there's a lot less work.
Yes, I appreciate the setup. So
Is that the next one on your list?
no, it's not, but you'll take it there, so I don't have to figure out where to get it in there. So one of the options is you could invest. Maybe you've heard of things called syndications or funds. A
Syndication is when somebody buys a property and you could invest into that property alongside them. Maybe they're buying an apartment building that's run down. They're going to turn it around, spruce it up, put new tenants in there, raise the rents, increase the value, eventually exit that. Like, you could go into that. Or you could do a fund, which is not specifically tied to one project. It's spread out across multiple projects. And the beauty is when you invest into these are much more of a passive investment, where you're going to put your money into these investments and you don't have to make any decisions. In fact, you don't get to make any decisions. You are trusting in the general partners, or often referred to as the sponsor. You're investing into them, that they know what the hell they're doing. They're going to take care of things. So you don't have to lift a finger. You don't have to think about it. You just get a report every quarter. Here's what's going on. And oh, by the way, here's your payment, right? Some of these will actually have payments that get made either monthly, quarterly, annually. They'll have distributions that come out. And some of them, there's no distributions until an exit occurs, either way. But like, for example, right now, there's a storage fund that I'm a part of where you have to be an accredited investor for a lot of these things. This is one of those you do have to be accredited for. So look up the definition of that. And but this, you could put in, let's just say $100,000. You're putting it into this storage fund, and you're investing. The fund already owns 3 storage facilities across the country. There's a 4th one that's under contract right now, but you don't have to do anything. You're told, oh, by the way, you own a piece of this and a piece of this and a piece of this. But something like this one has a 8% preferred return. So let's say you put $100,000 in, that's an $8,000 annual return, right? But that's like normal, right? We were just talking, that's like a normal IRA return. But that's just what you're getting on the annual. And that one, it's paid quarterly. So 8%, $8,000 paid out over 4 quarters. Let's call it $2,000 a quarter. But then you're going to be a part of the exit as these projects sell over the course of a 5-year investment. The projection is a 2.4 equity multiple, which means if you put 100 in over the course of the 5 years of this fund, the projection is 240,000 out. So 100 in, 240 out.
Does that include the...
Includes the 8%. Yeah. So total in is 100, total out projected 240. That's pretty cool. That's a way better return than the 5 to 8% that most people are getting on their existing retirement account. And the beauty is you don't have to lift a finger. You just put the money in, money sits there, you get reports, you get distributions, then this thing exits, boom. And then depending on, the syndication or the fund you're in, you maybe could even 1031, go into the next project. That's always an option. And now if you do this inside of a self-directed IRA, this doesn't apply, but if you do this outside of a self-directed IRA, there's also tax benefits that come along with this, and the beautiful thing called depreciation. So whenever you're investing in investment real estate, you're going to get to depreciate the asset or assets that are in that investment. So the projected first year depreciation on that storage fund is 30%. So if you put $100,000 in, the expectation is roughly a $30,000 depreciation write-off in year 1, which means, let's say your income after all your write-offs was $250,000. Well, $30,000 write-off for the depreciation. Now you're only paying tax on $220,000. So you're reducing your tax liability as well. Again, that doesn't apply if you're doing it inside of a self-directed IRA. That's if you're doing it outside of it. But that's just another layer of icing on the cake. So if you are watching, you're listening, and you want more details on this storage fund or just this whole investment opportunity with syndications, funds, all that stuff, just DM me. I'll get you some details. I'll walk you through it. I'll connect you with the team. But it's just something, if you're looking for more passive stuff where you don't want to get into a flip where you got to hire contractors and deal with all the things, like you just want something that's a little more simple. I'd love to have that conversation. So just DM me anytime at Kyle Whissel on Instagram. And
real quick, you mentioned it's for accredited investors, this
particular one, but there's other opportunities we have where you don't have to be accredited.
Sure. So. But if I don't know if I'm accredited or not, I'm not.
Yeah.
Likely. This is still a good opportunity if someone's talking to friends, family members, that if you're like, I don't know what Uncle Bob does, but he drives a Porsche and he always talks about investing and it's really annoying at Thanksgiving, like maybe give him the opportunity.
Yeah.
Or even your clients that are like, you hear things throughout transactions, you hear things of, while you're having conversations, hey, you looking to move anytime soon? No, actually my investments aren't doing so great. Weird, I actually heard of one that has a really good return.
Yeah.
Can I introduce you to the guy? And that way, what's cool is, will you get money from it? No, you can't get a referral from this. But you're helping your clients do something good. And now you are a resource for more than just buying and selling a house. Now you are being seen as a resource for investment opportunities. The more you can be for people, the more they will think of you, the more business you will get.
Yep. It's all about relationships, baby.
Yep.
So don't think, my client put $500,000 into this investment, so now they can't buy with me. If they had $500,000 to put in that investment, they got plenty of money to buy with you. Okay, don't worry about that stuff. And to figure out the definition of accredited, it changes over time. So just Google it or go on the IRS website. But you basically have to have a certain net income excluding your primary residence, or a certain amount of annual income if you're single, married. So you guys can look up that definition.
It's like 200 billion.
200 billion, exactly. So we'll hit 2 more things before we wrap. One, depreciation. We touched on it a little bit, right, on a simple level with investing into a fund or a syndication. Usually they can tell you up front the approximate amount of depreciation you could expect on your investment. Alternatively, you can just go buy an investment property, right? So whether you want to buy a single family, a short-term rental, apartment building, an office building, whatever, depreciation is the eighth wonder of the world. It is the way that most people of high net worth are able to wipe out a lot of their taxes. And the beauty of depreciation is it's considered a paper loss. So let's assume you had $1 million in adjusted gross income, but then you had $100,000 of depreciation from a property that you purchased. Now you're only going to pay taxes on $900,000, not the million. But what's cool is when you go to apply for a mortgage, they're going to look at your AGI, your adjusted gross income, and be like, oh, so he made $900,000, and then they're going to go look at your depreciation column, and be like, oh, there was $100,000 in depreciation. So for mortgage qualification, you made $1 million. But for tax purposes, you made $900,000, which is pretty freaking cool, right?
That's like double dipping.
It's a
cake and eat it too.
It's a beautiful thing. So just the simple way that this is done is that when you buy a building now, they're going to do a cost segregation study on it. They're going to break down all the components of the building, the floors, the roofs, the windows, the electrical, the HVAC, plumbing, all that stuff. They're going to bucketize things into one of 4 buckets. It's either going to be 5-year, 15-year, if it's a residential property, 27.5 years, or land. So they're going to break it into 4 buckets. Currently, anything that's in the 15-year or less bucket, you're going to get to depreciate all of that in year 1 that you put the property in service. So most properties, depending on the part of the country, we're in California, land value is a lot higher. If you're in Kentucky, land value is a lot lower. So it's going to vary, but somewhere in like 20 to 40% of purchase price is a rough expectation of how much depreciation you could get. So let's assume you bought a building for $1 million. Does not matter how much money you put down. Has no bearing on it, whether you put $0 down or you bought it cash. You bought a building for $1 million in California, a reasonable expectation of like $200,000 of write-off. That's very reasonable. So you could buy a property and get $200,000 write-off this year. Like that's pretty crazy that you could do that. So you need to understand that. You also need to understand real estate professional status, because these write-offs are typically only going to cancel out passive income. Unless you are a real estate professional, then you could cancel out your ordinary or active income as well, meaning like your commission income for us realtors. So you do need to understand real estate professional status. You can research exactly. There's some different tests that you have to qualify for that. Alternatively, if you can't qualify as a real estate professional, maybe your spouse can qualify because they don't have a job. It's easier for your spouse that doesn't have a job to qualify for a real estate professional. So maybe you're a doctor and you can't qualify, but maybe your husband or your wife can qualify as a real estate professional. That's one workaround for it. The other workaround is what's called the short-term rental loophole. So if the investment property has an average stay of 7 days or less, you don't have to be a real estate professional. So getting real estate professional status or doing a short-term rental, that allows you to take that depreciation to not only wipe out passive income, but also your active or ordinary income.
My kids don't have jobs. Can they be real estate professionals?
Not yet. Not yet.
Okay. So we have depreciation. Cool.
Last one we'll hit, because I know we've probably going over a bit on time here.
Not too bad. We're at 33.
Okay. It's called Section 280A. Section 280A, or the nickname for this is the Augusta Rule. Augusta, if you're like, that sounds familiar, why? It's Augusta, Georgia, which is where the Masters golf tournament is played every year. The story goes that a lot of people that own homes there, they rent them out during the tournament because they can rent them out for an obscene amount of money. And so this IRS code was added in that you could rent your primary residence out for up to 14 days per year, and the income that comes in comes to you tax-free. Now, whether you Airbnb that or you let people throw events at your house, whatever the case may be, up to 14 days per year. So I have friends who, when they travel out of town, they actually rent their house out because they're like, we don't need the house. We might as well bring in some money while we're gone. We can actually pay for the trip with the money that comes in from the rental. So you could do that as well.
Can you rent a portion of it, of the house?
Yeah.
So like, you could have friends that are coming to stay.
Yes.
And instead of paying
charge them
$600 a night at a hotel,
pay $300. Yeah. Just again, it's 14 days a year. That's the key criteria on that. We do it with our company, and here's what's cool: is your company can rent it from you as an individual, or your trust, or whatever. You hopefully you hold your primary residence in a trust. So your company can rent it from you, and So your company gets a write-off and you get to take the income in tax-free. Obviously, make sure 2 things. 1, it's a reasonable amount of rent. So have comps on Airbnb, or if you're doing it like by the hour, peer space, PEER space. Make sure you have comps. So if you got audited, you could substantiate the number. For us, we do something we call media day at my house a lot. All the agents come up and we shoot photos and videos and stuff and create content at my house. We do our quarterly offsite meetings at my house, things like that, where you could prove that you actually did it. Plenty of people do this illegitimately. I'm not trying to play that game. If I get audited, I could prove it. Like, here's all the videos we shot that day. Here's all the photos we shot that day. So you could rent your house out 14 times a year and take a big fat write-off from your business and put all that money into your personal bank account and not have to pay taxes on it. So that is Section 280A, also known as the Augusta Rule.
So these are, as a quick recap, what I wrote down. We'll figure out if I'm right. Do an S Corp, or if you have an LLC, do an S selection. Hire your family members, so that way you can reduce your tax liability, but also pay for things that they do anyway. Move over an old IRA or 401k into a self-directed IRA, which then you can use to invest in real estate. A syndication or a fund or a flip, utilizing one of those tools depending on your level of knowledge, risk, time, involvement. Depreciation from and that's not a prime, that's for investment properties. And finally, the Augusta Rule, or Section 280A. You mentioned Mark Kohler, K-O-H-L-E-R, and then
Carlton with a K, Dennis, two of my favorites to follow. That's where pretty much everything that has been shared with you are things I've learned from those two guys. So they're both on YouTube.
You took the hundreds of hours you've watched and put it into 36 minutes.
Yes, so hopefully you guys appreciate. Again, this is not tax or legal advice. Talk to your accountant, CPA, financial advisor, attorney, all that stuff. Confirm that the understanding that I have of this stuff is the same understanding, because I'm not the one signing your tax return. So they
just
are.
For fun, say you are a tax professional, and I can use that if I want to later.
And if you guys want more info on that storage fund or any of the other stuff that we talked about today, just DM me at Kyle Whissel. Or if you want to stay connected with Brian and find out what kind of goofy shirt he's going to wear, where he gets his goofy shirts from, he is at Bryan Koci, Koci, on Instagram. We'd love to stay connected with you guys. Thank you so much for tuning in to this episode of the Whissel Way podcast.
See you next week.